Conference attendees, please enjoy the session titled The Future of Financial Compliance, sponsored by Sterling Trading Tech.
Well, thank you all for attending our panel discussion this afternoon on the future of financial compliance. Risk is a key player in RegTech. My name is Brian Saldine. I'm the Senior Product Manager for Risk and Margin at Sterling Trading Tech. Sterling Trading Tech's a leading fintech provider of trading platforms, OMS, and a risk and margin system. Our risk and margin system can handle multi-assets, including equities, options, futures, options on futures, as well as FX and crypto, and allows you to manage your regulatory margin requirements, as well as your the risk management aspect of large numbers of portfolios, large numbers of unique symbols. I'm joined today by Matt Lyle. He's the Chief Futures Compliance Officer at Wedbush Securities. Matt, thanks so much for joining us.
Thanks, Brian, and thanks to Sterling, and thank you all for sticking around late on a last day of the convention to listen to us.
Yeah. Well, let's dive into it. How have regulatory perspectives on risk evolved in recent years, and what key factors are driving these changes?
So we had these questions ahead of time, and I was able to think about this a little bit. So I don't want to go back to the beginning of time, but certainly in the old days, let's call it, and that would be 10 years and beyond, cataclysmic events, catastrophes, and so forth were, the things that people just waited around for, and they happened, and people just endured through them. 2008 happens, Dodd-Frank, regulators say, get really serious about this. They educated themselves on what you should be doing and put in various requirements regarding risk management programs, which would include, obviously, monitoring, your customers' exposure to the markets. And so as we've come in the last 10, 12, 14 years, the expectations are dramatically lifted up by the regulators in terms of what they expect to see in a brokerage. They expect to see that you are monitoring and actually that you are going to be proactive, which is the key word.
Right.
Yeah,
and obviously technology has changed the perspective a lot too. So we have much better tools, much more better capabilities than we ever had in the past.
Yeah, absolutely. I mean, especially in the futures environment, where volatility is a huge factor. Your clients, your traders tend to engage in volatile markets because that's where the opportunities are. But again, you have to be careful, with these customers, and you have to know what their true exposure is, and that's a lot of times not quite apparent on the face of things.
Sure. Why is real-time risk management becoming increasingly critical in today's regulatory landscape, and how are firms adapting to these changes?
Sure, that's a good question. So, the older tools would have been a little more static, would have been, hey, given this client, how much credit are you willing to give them in terms of what they can play with in the marketplace? A lot of times, a lot of traders, day traders, they come in, they trade, they go home flat. Those are, escaping some of that sensitivity. You have a little more difficulty in terms of tracking that risk. With real time, and if your system is updating at a real-time basis, now I'm seeing that day trader exposure throughout the day climb and go down. And you're watching for patterns. You're watching for things that aren't necessarily indicative of anything that's going wrong. But you need to be on top of things, and you need to watch, in case things do go south. And those things can happen even if markets really aren't moving all that much. So it's important to I think at least from a compliance standpoint, to be able to reflect and demonstrate that we are on top of our client risk.
Yeah, it makes sense. Yeah, I think back 20 years ago, and a lot of our risk management would have been report-based, batch processes, and now, of course, we have the capability to see things in real time. It really opens up the business to allow you to provide more risks to your client base, again, which is better for everybody. They can express their views, and it's much better for your business.
Yeah, absolutely. It also, leads to probably more conversations between your risk department and your clients, which I think is a healthy thing. It's not necessarily a bad thing for, the risk department to be calling a client. A lot of times, because of these tools and you're seeing things unfold, you want to understand what the client is doing. And in most of the cases, our clients are sophisticated enough to have a pretty good story of what they're doing. And also, they're almost partners, and especially if you're talking to them a lot, they understand where you're coming from, where your concerns are, and they even anticipate those calls.
Yeah, I found that clients are very accepting of risk management as long as it makes sense to them. So being able to communicate that, being able to show them the analytics, the calculations behind what you're looking at, and explain yourself, I think that's really important.
It is, and it's important from that perspective, and it's also important because if you're sitting there and not doing anything but kind of waiting for the other shoe to drop, it's something that you're not demonstrating the proactiveness that you need to demonstrate to regulators. A perfect example would be you should have a process in place to take advantage of some of these tools, like a stress test or VAR, VAR, in terms of measuring it, tweaking the models, making sure that you're on top of the latest changes, innovations, but also, markets change, complexions change, your client base changes. So you really have to stay on top of things.
Absolutely. So yeah, there's a lot of innovation in the financial markets, things like leveraged ETFs, volatility products, where we see a lot more volatility than we do in kind of some of the more traditional asset classes.
Sure. There's a lot of strategies out there that are pretty good until they're not.
Right.
And a lot of those are in the options space. We're all, I think, familiar with the incredible tail risk of selling premium, which is a great strategy until it isn't.
Right. Well, given that risk management doesn't directly contribute to revenue, what arguments can be made for viewing it as a critical investment rather than just a cost?
Yeah, so we were talking about this just before we got up here, and I think the most important thing from a regulatory perspective is there are, since Dodd-Frank and since 2008, there are now specific regulations around risk management programs that FCMs have to run. And this would include monitoring market risk. And, if you're not on top of that, you are in, basically you're not in compliance. So, in terms of what you're doing with that, what you're required to do, you're also expected to spend money. And since, it's not just a paper requirement, I can tell you that auditors come in and they ask and they look and they want to see. I can also tell you that when I do an annual CCO report, the CFTC wants to know what sort of resources are dedicated by the firm to compliance. And what we tend to do is we tend to reflect it in a percentage standpoint. So they want to see some material significant investment in compliance. And I would include market surveillance as part of your risk management program as a cost of compliance. You have to throw that in there. It's a great way to show that you are taking, regulatory compliance seriously. And it can certainly, I don't know. I mean, at the end of the day, is the expense justified just by the fact that, a cataclysmic event could put your firm over the cliff?
Sure.
And so I think that there's a number of reasons why it's a good idea to invest in these kinds of systems.
Yeah, I think many firms aren't looking at it as just a check the box function anymore. It really can help drive their business, drive success with the business. Again, it can be a differentiator for your company to have great risk management and to be able to give that to your clients.
Yeah. And, and actually another thing just came to mind, we have redundancy. You might want to look at having, if you only have one system, you might want to think about having another one just in case the first system goes down for some reason. Not only that, it's good to have, a backup in terms of maybe a different approach or a different view of the risk.
Absolutely. Do you find that your leadership teams and board members are receptive to increasing the allocation to compliance and risk management?
I do. Certainly it's always, compliance or risk. We're always, we're not looked at as a profit center, certainly. And that can lead to, some friction inside of a company. There can be a lot of lip service to things. Hey, yeah, it's a great idea. Let's take a look, and nothing happens. But what I've seen over time is boards and management, their attitudes have changed. I think a big part of that is regulatory risk is now huge. $1 million fines are common. It's almost like the starting point for any sort of regulatory settlements. So at the end of the day, I think these things are, expenses are justified.
Sure. We talked a little bit about this before the discussion here, but do you see a large difference in the way different regulators are approaching risk management and how they work with your firm?
So we're also a broker-dealer, an FCM, and a swap dealer. Each one of those businesses presents a different risk profile, and each one has its own regulator. Mm-hmm. I can tell you that just from a philosophical standpoint, that a FINRA or SEC is much more prescriptive. So I would hazard to guess, I'm not a SEC expert, but I would hazard to guess that those FINRA regulations especially are a lot more specific in terms of what they expect. They'll walk in and they'll want to see it. On the future side, much more principles-based regulation. But I think that the goals and the objectives are the same. The regulators expect that you have certain things in place to be monitoring the risk of your business across the board. And one of the things is that they're going to expect to walk in, they're going to want to see a market risk monitoring system, and they're going to want to look over your shoulder and see how you're working it, what are you doing with it. And at the end of the day, if you're not doing that, you're going to have some issues with the regulators.
Yeah, makes sense. I think that concludes our discussion today. Thank you all so much for joining us. Matt, thank you for joining us. We really appreciate it.
Thank you.
Conference attendance.